will rates go up in 2021? If you're that person internally thinking to yourself, I want to buy, but I think the prices are going to drop. And then the other side of you is saying, I want to buy because rates are going to go up and I need to make a move soon. This video is going to be really helpful for you. In this video, we'll go over 3 different points. We'll be able to give you guys some data to make a really good decision so that you can decide what you want to do and not feel like you're being tricked into it. But before that, please hit the like button, subscribe to our channel. It really helps us a lot. Hit that like button because it's going to be able to allow other people that need this information to get it in front of them due to the algorithms. And just to help a little bit, here's a picture of a really cute dog just to give you a little thank you for hitting that like button. So let's start with where people generally think mortgage rates come from. I can't tell you how many times I've had people come to me and say, the Federal Reserve announced that their rates are at 0. So how do I get that 0% mortgage interest rate? That is not how it works. The Federal Reserve does not control the 30-year fixed rate mortgage. The Federal Reserve, what they have responsibility over is a federal funds rate. That federal funds rate is an interest rate that impacts very short-term bond investments. 30-year fixed rate mortgages and the general mortgage rates across the country are based on longer bonds. So because they control this part, we need to clarify, this part does not equate control over the rest. Rates are going to be going up or down based in one big major factor. Now, before I get into that major factor, let me share that the Federal Reserve does have some type of influence over 30-year fixed rate mortgage, or at least how we've seen here throughout the COVID period. When they decided to buy mortgage-backed securities so that rates could come lower, that did have a direct impact in bringing rates to where they've been in the COVID era. Now, when they decide to stop buying those mortgage-backed securities, the long-term ones, not their control of the short-term, but their purchase of the long-term, it's called tapering. When they decide to start tapering, that is going to have an impact on where rates go and how we see them increase. Now, off that side note, coming back to the central part of what affects mortgage interest rates, let's look at it. The number one thing that's going to be affecting mortgage interest rates in regards to where the yields are, what's going to be happening, is specifically the economical health. How healthy is the economy? Where are we? That is going to be producing the most impact. And when we look at the economical health, there are 2 major components that everyone is keeping an eye on to see what's going to be happening with the actual mortgage rates. It's inflation and it's where businesses are. What that means is, have we hit the top of inflation or is it going to get worse? And where is the economical health in regards to small business owners, big business owners, jobs, the security of the economy? Where is it? If it is in a healthy position, rates will be increasing. It's not in a healthy position, that's where we might see another rate drop. If our economy is in a place where we do not see businesses roaring back up, 1, because they can't, since all their savings got depleted, or 2, they can't find employees to come back and work, or 3, we see inflation actually not get so much worse than everyone was thinking, but actually has hit their peak. All 3 of those factors will be impacts on bringing rates to a lower position, even with everything we've discussed. So how do we know if this is going to happen or not? Honestly, we're not going to be able to know 100%. Yet, at least this gives us what to be looking for as the data continues to come out month after month after month, after the Federal Reserve continues to give their notes on what they're seeing, when they're going to decide to not taper, and as we continue seeing inflation reports increase, decrease, where it's at, what is going to happen, is it short-term, long-term, all those things. But again, to summarize this in one sentence, if the economy does really well, rates are increasing. If the economy does not do really well and we go into another type of recession, rates will be decreasing once again. So let's look at some relationship between rates, prices, and monthly payment, right? The reason why we get hesitant is because we're thinking, I don't want to miss out on a good deal. Yet we only determine good deal based on what we're assuming, not what is actually fact. So that being the case, let's just look at a few examples here to kind of go through. So if we bought a $650 purchase price in today's market, and I'm looking at what the average rates are based on July 30th, 2021. If we buy a $650 purchase price there, the average interest rate would be a 2.987. Your monthly payment would be $21.88 before taxes and insurance. That's with 20% down. Now, in this same scenario, let's say this is the type of person who's saying, we're gonna wait, we don't know what's gonna happen with rates, and we're just gonna keep battling it internally. This person now, if they waited that 1 year because of this internal struggle and house prices increase only 5%, this purchase price is now $682,500, and with rates going up a quarter, that would bring us at a 3.237, leaving us at $183 more a month, $23.72 every single month. That would be the cost of what this person would now have to face if they waited. Now, this also means they need to be able to ensure they still qualify. If their debt to income ratio is already tight, this might now put them in a position where they can't buy the $650 house a day. The house that they would be buying is one that would have been worth maybe $630, $620 at this time that they're shopping. What if rates go lower, Sosi? Sharing that the economical health has such a major impact on where rates go, if the economy does not reboot in how we're expecting it to or would like it to, and it does truly come down lower, what would happen then? Well, if house prices continue to go up the way they are because of the basics of supply demand at that 5%, even if rates go down a quarter, you're still paying more on a monthly basis. Therefore, at this position, the house price and good rate options that we have will bring you the most savings. But Sosi, what if rates go down even lower than a quarter? What if our economical health from what you're sharing actually makes us come down to way lower rates? What do we do then? That's a great question. Let's look at a couple scenarios to understand that, because if rates get lower, there's two things that are happening. You're either still renting without a home and you're just waiting for that payment, or you got a home and you can potentially look at a refi. So this brings us to this third point, right? If you are doing one of those two things, renting or buying, what would be your scenario in each one of those as you're waiting to see what move you're gonna make? If you ended up, let's say, moving now, and we look at you buying that house, $650, the average interest rate that we looked at according to Optimal Blue, the monthly payment with tax and insurance and everything now included would be $34.26. Out of pocket, you'd be looking at about $45,000 from an estimated standpoint. Now, in 1 year, when the question comes up, what if rates drop another half a point? How am I going to get the best savings? If you were a homeowner, you would now be able to leverage the growth of equity as a newer loan for you. Effectively, what that means is if you wait, that money that the house has increased in value on is your money. That now becomes your equity, and if you refinance, you could effectively be saving about $212 a month if that rate does drop that half a point. In comparison, if you don't buy the house now because you're waiting for those rates to drop and you want to see that capture the best savings for you, even if you waited and the houses are still going up that 5%, $682,500, 2.4875, look at your monthly payment, $34.26. It is almost the same minus the 21 cents. So if you want to wait to save 21 cents, but buy that house in a year now at a more expensive price, instead of buy it now and then leverage it later, feel free to do so. Now, anybody who wants to bring an objection, one of the first objection goes, well, if I wait later and I do the refi starts the payment all over again. Well, yeah, it starts a payment all over again, but now you have extra money that you were already budgeted for to put into your principal. If you buy and then refi and then use this money into your principal payment, instead of just buy when you feel rates are dropping at the lowest they're gonna be, you would actually pay off this loan almost 4 years sooner than the other. So if you want the home at the best price, now we see that buying the home at the initial price and that monthly payment doesn't always equate to having the lowest monthly payment overall. If you want to get low rates now with the home price that is solid now, most likely going to be far lower than it's going to be in the next few years, Buy the house now, get that monthly payment locked in, and if your objection that comes in is, well, what if rates drop again? We've already seen, if rates drop again, you lock in your house now with your current purchase price and current rate, you'll be able to take advantage of those lower rates in the future, or you should be able to, and then be able to save the money, take that as an extra principal reduction, and even get out of debt overall faster. So I know a lot of what we discussed today is countercultural. It's not the conventional wisdom that many people try to build a brand off of or try to make you addicted to their advice off of, but these numbers are numbers and that's all they are. So I hope this was helpful to you. I love bringing out content like this. If you'd like more of this, I got some good news. We are now making a newsletter that will be able to keep you updated with how the numbers actually look instead of how people are trying to sell them to you. So if you'd like to be able to subscribe to this, feel free to do so. The information is going to be here on this video, so check it out. I'd love to be able to give you some more information there, but most of all this information being brought out, I know can start a lot of great conversation. What is the number one thing that you thought to be the most thought-provoking? And share with me what your contrary advice is as well. I'd love to be able to hear it. I'd love to learn from you as much as you guys are learning from us and what we've been able to discover in the studies of finances, mortgages, real estate, and ultimately trying to be free in the midst of all that. I would love to learn more from you guys as well, so please leave a comment with what you think was the most interesting thing, what you'd like some more information upon, and even some objections that you guys might have to some of these thought processes. I'd love to hear from you guys. I can't wait to be able to do that more. Looking forward to chatting with you guys in the comments, and I will see you guys next time. Bye-bye.